Hi, everyone, and welcome back to another show. My name is Tyler, and I'm with Matt, the founder of ORATS, an options analytics platform built on top of over 15 years of historical options data. Our dashboard is integrated with Tradier, meaning you can research and discover trades on our platform and then seamlessly send them through to your Tradier brokerage account. Today on the show, we're going to talk about implied moves around the election. Matt, do you want to share your screen and get us started by going over our current positions?
Can do. All right, so we just had one trade from last time. Let me just get it here. All right, so we had a SPX. Let's see here. Yeah, short call butterfly. We're down a bit, so it's pretty flat delta. We're just waiting for the slope to come our way. So we still got a month to watch this, and hopefully it'll move towards us. It's been moving. So here's the position in our graphic. So it's been moving towards this. We kind of don't want it. We're right at the low point here. So if it moves either direction, we're going to be good. It's not really a move trade. It's also a slope trade. We talked about that before. On the trade builder, we could see the slope if you type it in here. You could see the slope has now come back up a little bit. We think it's pretty high, but it's still kind of sticking around. So we're waiting for that to come back down. And this is our profit area. This is about as high as it gets. So this is where it is. So that's what we got, Tyler.
Great.
Yeah, what are
we can jump right in. I think, for this show, we're talking about implied moves. I think it'd be helpful to kind of go over first our implied earnings effect calculation and show how that's shown in the dashboard and the earnings graphic, and then just sort of explain how that works, and then how we can sort of use that same calculation and methodology and apply it to the election and other types of macro events.
Yeah, sounds good. So right now, so we're looking at SPX. So this doesn't have an earnings. So we'll talk about earnings, then we'll talk about the election. But what we're seeing here is you can clearly see that there's all these expirations that are pre-election that are way down here, and the post-elections are down here. So there's obviously going to be a large move. The question is, how do we figure that out? Well, we have been at this for a long time with stocks that have earnings coming up. So we could go to the earnings and we could see, let's see, Tuesday AMD is coming out. So these are all the earnings stocks. If they're red, that means that the actual move is below the implied move, or it's a sell, or it's red. So that's how we'll look at it. So if you look at AMD in the trade builder too, what you'll see is, extremely high implied volatility is coming up to earnings. So what we have a way of doing is saying, well, even we have to figure out where it's going to fall to, right? So it's going to fall to a certain spot, and then we draw a rational skew through that assumption of how far volatility is going to fall, what the move is going to be, in order to make all these relationships between earnings make sense. So it's a little bit hard to explain, but that's how we do it. And there's another factor that makes it more difficult, is that you're not just looking at a straddle price. You can, but this is another method to look at just what the straddle price is, and you could say, well, that's how much the market thinks the stock is going to move after the earnings announcement. The problem with that is that there's often days left, and so we have a way of looking at what the distribution of stock prices might be after a large move from earnings, and then figuring out what the straddle is going to be worth at all those different points. And then when you do that, and you come up with a probability, you come up with an expected straddle price after, or what we call our residual straddle price. And then you could net that out from the actual straddle price and come up with what we think is a much better way to look at what the market's just implying for that one move. You'll see people out there, they'll say, oh, the market thinks AMD is going to move at 8%, but they haven't accounted for that. So it's more like, 6.5% or something. So that's how that moves in general, or that's how we calculate that in general, Tyler.
Yeah, I think it's important to understand the difference between the implied earnings move and the implied earnings effect, because we're going to be seeing that a lot around the election.
Right. So yeah, the election, obviously different. So the election now, if we go back to SPX, has that same look. So it's very similar. I mean, it's just a matter of applying that same logic to that we do with earnings, but it's saying the earnings is November 5th. So we look after November 5th and see what the relationships are and what the implied move is. So when you do that, and we've done that for SPX, and not only have we done it for SPX, but we've done it for other. So let's just look at this. This is a cool thing that we've just put together today, just for you guys. So we have on this graph the implied moves across sectors. And so we have tech, defense, and health. The reason we chose those are generally the most important around elections that will move. So we're looking at the SPX, and we take that implied move, and we've taken it kind of historically every month, August, September, October, and then now kind of weekly into today's look at it. So today we're down at about 1.5. So if you look at blue, that's SPX, and so we think that the market is saying a 1.5 move is expected on the election. And the neat thing about SPX is they've had a daily Tuesday or Wednesday, I should say, expiration. So we're able to, finally look at this, FINELY, and look at this and really look. And ORATS has such good ways of summarizing the implied volatility skew. It's another thing that we do better than anyone, we think, because we use many different points. And I'll just point that out actually right now, Tyler. I'll show you, like an SPX, what we do to summarize that implied volatility skew, because you see how important the at-the-money volatilities are. So by having those very accurately, we could then come up with, you could see how well we draw a line through there. We also solve for in this case, the implied futures rate. And then we're talking about now how, the volatilities are getting so high right around the 6th here is where the big implied volatility jump is. And so that's a big jump that we're looking at, and that's what we're really talking about. But really, here, I'll show it in this front month. It's drawing this orange line through all the put and call implied volatilities and solving to make sure the call and put implied volatilities are close is the important thing that we do in order to get these really accurate numbers, in order to be able to make a graph like this. Is it not the graph? This graph. In order to make a graph like this, you need very accurate implied volatility numbers. That's it.
Yeah. So I posted a link to the university section where we talk about the calculations, about the earnings effect and the implied move. So if you guys want to learn more about it, you can read more there. I want to ask you, Matt, now that we know how it's calculated and what it means, how can traders use this to their advantage? How can they use the ORATS implied move calculation and make a strategic trading decision around that?
Right. So again, we're looking at these various sectors, and let me just make sure I have this right here. There it is. So then we also have not just sectors, but we have gold and TLT and XLE. So this, in addition to sectors, we're also looking at segments of the economy. And so before we get to your question, we want to try to find something in all this data, because this is very difficult data to come at and to get. And so if we're armed with this, what have we learned? And so let's just kind of go into this. So one of the big things that we're seeing here is energy has really come down quite a bit. Traders were thinking that energy is the green line here. Traders were thinking it was the energy markets were going to move by more than 3.5%, only as far back as August, and as things started to get more clear around the election, that has come down quite a bit. What hasn't gone down that much is the purple. TLT is pretty much, 2.5 down to 2. That isn't as big a move as 3.5 down to about 2.2, which is where energy is now. And for that matter, gold and the SPX are both pretty similar, coming down from implied moves of 2.5% now down to 1.5%. So it's actually 1.5% is a pretty small move for a big occurrence in the economy of the election. So I guess the things that I would be thinking about are that I think that the market is a bit complacent about what's going to happen here. So we've seen XLE. Let's just see. I'll go to my downloads. That's by segments. Let's look at across sectors. So sectors, I think sectors are kind of interesting because in this line, what's really come down is tech has come down from almost 4 to 2.5. So that's pretty low in my estimation. But defense has remained relatively constant, like right around 2.5, 2.2 to 2.5. So I think that's pretty interesting. So what you want to do is look at these numbers and think about, okay, what are these numbers telling us, and how might we be able to profit from this? So what I think this is telling us is that people are becoming very complacent about what's going to happen in the election is what I take from this. A couple of things have started to come up. Like you could tell SPX has come up in the past week, from under 1.5 to about 1.5. XLV has come up. So I think a long play here, a long volatility play, a long gamma play would be something that I think about. Do you have any feelings on that after seeing all this, Tyler?
Yeah, these are very interesting graphics. I find it interesting, just the overall trend going down leading up to the event. I mean, in my experience, you usually see if there's an earnings event, you usually see implied volatility heading upwards toward the event. So it's interesting to me that the history of this implied move has been going down.
Well, I'd like to just point out something that you said. You said implied volatility rises, and that's true. So let's just point out what you just mentioned. So you said that correctly, that implied volatility tends to rise as we go into an earnings. So let's just look at, we saw AMD before, right? So let's look at AMD. And let's look at the trade builder. Yeah, trade builder. And so what you're saying, and I agree with, is these vertical lines. I think we've done this a really good job of showing us. Every earnings is here. So the earnings in red is when the stock is down. The earnings in green when they're up. But what you're talking about is the effect where earnings just tends to go up. Excuse me. Implied volatility tends to go up. After the announcement, it comes way back down. It tends to go up.
Zoom in a little bit, Matt, as we can see it a little better.
If I zoom,
Yeah, that works. That works.
Okay. So you can see it coming up towards that line and then dropping. So that line is earnings. So what you're saying is implied volatility goes up before earnings, right? But that's not really the way to think about it, because the implied move thinks about that, because the implied move will increase as the event comes. It doesn't mean that sorry, I should say that again. The implied volatility will increase as the event is coming, but that doesn't mean the implied move is going to be bigger or smaller.
I see.
Yeah,
I was thinking they were the same thing, but they're different.
Yeah, it's a very subtle thing, but this is an important thing to learn, is that people will talk about the implied volatility crush and about implied volatility going up until earnings, and so let's just buy implied volatility. Well, it's all baked in. Like it's not whether implied volatility is going to go up. It's what is implied volatility is implying. And when I say it that way, it's the relationship between the implied volatilities, and that's when you get to what the implied move is. And so the implied move could be the same, and implied volatility will go up to the event. So that's the important thing to understand. I'm not explaining, I'm just kind of stating that's what happens.
No, it's an important distinction, definitely.
Yeah. So I think that's the important lesson from today. But I think now what we could do is start to say, okay, what should we do to profit from this? And again, I'd like to go back to, we look at implied volatility across economic segments, and we look at implied volatility across segments and across industry sectors. Okay, so sectors. So again, the biggest sector that's down is tech. Now, so that might have the biggest chance to go up. So it could be like kind of a tech thing that we'd be looking at, or it could be something where we could look at the other one, the segment. Let's see, segment. So the biggest segment is energy. I kind of like energy. Let's take a look at let's look at XLE. We haven't done too many trades in XLE, but let's take a look at XLE and see what we can surmise. So again, this looks pretty low as far as what I would think before an important announcement at earnings. So we have November 1st, November 8th. So they just have the Friday. So what I would do here, Tyler, is I would do a calendar, which would be selling the 1st, and then we'll be on for the 8th. So I think we should look at that. So let's go over to the option scanner. Let's clear everything. Let's put in XLE. Let's pull up we'll do a call and a put calendar. And so we want to buy the 8th, and we want to sell the 1st. So that's like, the 1st is like 3 days out, right? So approximately 3. So it's like between 2 and 7, and then we want to buy the 8th, which is 3 and 11, so it's about 11 days. Let's say 9. We'll get around it. So let's see. Before we put the put together, let's make sure this is okay. So that's what this is doing. So there's the call calendar, and then we could look at so our forecast doesn't really know that. So we'll talk about that in a second. So we'll do the same for the put calendar. We'll do 11, 9, 14. So do you understand what I'm doing here? I'm just trying to, I've come up with a philosophy, and I could go kind of out of the money here, which I'd like to do because it might even be a double. So I want to get out of the money here.
Why specifically further out of the money?
Well, I would like you could do it in the money, but actually, you know what I'll do? I think we should probably just widen it out, and just because we want to see it. We aren't getting that many results down here when we have it kind of near the money. So let's widen it out. I want to find a good, let's go 30. We'll just widen it out a little bit. All right, we want to find something where our distribution edge is decent, smooth edge. Again, we don't really trade a lot around smooth edge because market makers generally know what we're talking about. So we just want to have something, the forecast doesn't know all about this election that's coming up, but we still want to find something that's pretty good around that. So we want to increase the F, and we'll leave the risk reward. And so what do we got? So we got the long put calendar. So let's take a look at that. 60 cents. So we'd be selling the first. So that's 88 cents. So my theory is like that's a lot of money to get before the election happens in relation to what's happening after the election. Does that make sense, Tyler?
Right. So your plan is to basically make most of that 89 cents and then buy back, right? Or do you just let it expire?
Well, no, I want to be left with a straddle or strangle afterwards.
Okay.
And I want to like have it financed with these kind of what I think is an overvalued month. So actually, what I want to do, I want to have more of a strangle. So I want to have I want to have these a little bit out of the money. So this is right at the money. I don't want it right at the money. I should have answered that. The reason I want to go out of the money a little bit is I want those things to expire worthless on the first. So I want that at least 88. So that's for the put, the 88s. That's not bad. So I could do that. Like if it expires between 88 and 91, and we did both of these, we'll have a strangle on, and all of these will be have expired worthless. So,
got it.
Does that make sense?
Yeah. Okay, that's interesting. Yeah.
So we'll be left with a strangle, that's not that expensive, and we'll, obviously be hoping for the stock to move. So, so we're going to put this on. We'll give them a penny there because it's very tight, which is nice. We'll force that. And then we'll also, so that's the put side. We'll also do the call side. And let's go back to the scanner. Here's the best call. Now it's a 91, and we'll give them a penny. Well, we'll pay the offer, I guess. And all right. So we have that position on for XLE.
Yeah. So we're doing it on XLE specifically because the implied move is lower than we sort of expect in terms of the other sectors, right?
Well, the reason we did XLE is because we looked at where things were earlier in the cycle.
Right.
And let's see if I can pull that up again. Move again across segments. So we saw that XLE was jacked up, and then it has come way down. And my theory is that everything's so low right now. I'd rather, if everything reverted, that would be probably the most profitable one.
All right. So We're expecting it to revert to the mean, which means that the implied move is going to increase. And so that's why we sold the front month at what we consider to be a higher price than it should be.
Yeah, not revert to the mean, but revert to where it was earlier in August and September, where it's been. It's come down the most. So we think it's going to revert to where it's been before, and then so we hope that it's going to revert to that, and that's where we think we could be most profitable. And and as you correctly said, there's a lot of premium till the first, and so if we could get those. Essentially, we sold a strangle on the first. If by Friday we could get those to expire without finishing in the money too much, then we'll have that strangle that we own, because we did a call calendar to put calendar. A calendar is when you sell the front and buy the back. So we did it at 88 strike and 91 strike. So we'll have the 88. 91 strangle left over to when the election comes, and we'll have a whole week to hopefully have one of those finish way in the money.
Right. Yeah, you've done this trade before where you have two calendars on that sort of expire the front month to leave you with a strangle. And I think it's a very interesting trade, having two calendars on at the same time. I want to point out, I found something kind of analogous to the history of implied moves. If you go to the earnings and news tab, that's sort of what's most similar to the chart that you're showing for the election, right?
Yeah, obviously there's no news or election in there, but if you look at CVX is in Chevron, so these are the past earnings moves. And you could tell that this was a wide earnings move, and for Chevron, these however many times they've finished outside of the move. So yeah, this is a similar way to attack the same problem, but in this case, we think XLE. We think that XLE is going to move a lot after Friday into election week next week. So again, if we could be within, and even if it goes to one of our tenths, so this is like the payout picture on Friday. So we kind of wanted to go to one of our tenths, but even if it doesn't, I'm fine with I'm going to close the eye of the shorts. So this is what our strategy looks like with only the longs. And so the longs are $1.06 and 82. So it's like $2. So XLE is we're showing Chevron's price up there. I like weird. Tell Jonathan about that. So XLE is, so it could go down to 87 or up to 92. So that's if we were just to buy that strangle right now. However, we think we're going to get 48 cents plus 27 cents. So we think we're going to get 75 cents of free,
basically a free strangle.
Right. Yeah. So, then we're going to if it ends up within there, then we got, we'll have a nice, a nice price strangle for earnings.
Great. Yeah. It'd be really cool, to be able to back test these double calendars and implied earn moves plays.
Yeah, it's hard though, because in some instances you just have to do the analysis and do some things are back testable that happen all the time. You have to have a lot of observations, but with earnings you don't have that many observations. You can't really back test a lot, so you got to trust the numbers and you got to trust your analysis and you got to do some outside analysis.
Right. Okay. Yeah. Thank you, Matt. That was a great show, great demonstration of the double calendar and some great graphs with the implied moves and the history of them leading up to the election. So the election,
we work hard for the people.
Yes. It's on next Tuesday, right? So we'll get a chance to see how the implied volatility has changed leading up to it, and maybe we can adjust our position then, or double down.
Yeah.
Okay. All right. Thank you guys for watching. If you guys have any questions, you can email us at support@orats.com or leave a reply in the comments below the video. Thank you for Tradier for hosting us again. Thank you, Matt. And we'll see you guys again next week.
Thanks.
You know how the financial world goes. Here comes the buzzkill. Please make sure to take some time to read this boring disclaimer. We will owe you one.